Folks, one of the questions that I've been getting from my readers and my followers, my video followers, is whether there is a financial storm brewing on the horizon. And I think there is. And again, I don't know if this is going to be as massive as what we saw in February, but I am starting to see a lot of cracks in the foundation. So I kind of want to go and show you some of the things that I'm seeing that are causing me to be a little nervous about where the market's heading. And again, one of the things about pullbacks, we don't know how bad the pullback will be. It's very easy to measure that there will be a pullback coming, but it's very hard to determine the weight of that pullback. It's not something that's very easy to do. So the best we can do is anticipate that there is going to be something happening, but we don't know how severe it will be. Historically speaking, the more something gets wound up, the harder is the pullback. It's like a rubber band. The more you pull it, the harder it'll snap back. The markets tend to work the same way. And right now I'm starting to see that rubber band get stretched out. So let me show you little by little what I am seeing. So the first thing you will see is this is the this is the number of stocks in the S&P 500 that are trading above the 50-day moving average. And if you look at the June, I think it peaked around the first week of June, we had about 96% of stocks trading above the 50-day moving average. Currently, right now, about 73% of stocks are trading above the 50-day moving average. So we went from like 98% out of the 500 stocks, virtually, I guess, 470 stocks, if you will. And now it's about 2/3, which is still substantial, but it's substantially less, about 20% less. But look at the price action on the S&P 500 since that period of time. It's been going straight up. So you're seeing what is called a narrowing of momentum. That's when less stocks are propelling the market directionally. And that's happening right now. And the market is really getting stretched out because imagine you have a chariot, okay? And you have 4 horses pulling it. And the chariot's moving at about 30 miles per hour. And one by one, let's say one horse gets sick, and then another horse gets sick. Now you have 2 horses instead of 4, but you're still moving at 30 miles per hour. Those 2 horses have to work faster and harder, twice as hard to generate the same momentum. Well, the market is now operating on less stocks moving higher. Only 2/3 of the stocks that were propelling it 2 months ago are moving higher, but price action is still moving higher. In addition to that, we are seeing, let me show you this. This is the RSI oscillator, and you could see here the tops are getting higher. Price action's moving higher, but momentum levels are moving lower. That means that price action cannot generate momentum levels this high, that fast, where we could in June. And that's exactly what happened right here. Exactly, I mean literally exactly what happened in the period preceding the downfall in February. Look at this. Look at the momentum levels. You had higher, as you could see here, for some reason this line disappears. I must be doing something wrong. But you could see here that the RSI here is at 81. The RSI here is at 76, and the RSI here is at 67. Notice this is getting lower, 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 and notice price action is going higher, higher, higher. And then look at what happens. Boom. The same thing is happening here. We're seeing price moving higher, and we're seeing momentum levels. They're still higher. They're still overbought, but not in comparison to what we saw back in June. But price action is substantially higher. Look at this. Here in June, we were 320. We're here at 346. Less stocks is causing that upside. And the same thing is happening in the NASDAQ. Speaking of NASDAQ, if we look at the NASDAQ 100, this should be eye-opening. This is the NASDAQ 100. This is the fastest growing 100 NASDAQ stocks. And that's usually technology and biotech. And if you look at this right now, let me just show you this really quickly here. You will see that price action has been going higher and higher and higher, higher. But let me show you the exact same exchange, the Kosdaq exchange. This is the tech exchange in South Korea. Look at the last since we peaked about August 10th, excuse me. We're now in August 24th. That's 2 weeks later, right? Price has gone down from 867 to about 815. That's about a 12% downside. But the NASDAQ 100, if you look at it over the last month, this is the last month on the NASDAQ 100, and this is the last month on the tech sector in Korea. Almost identical companies, but notice they're starting to cool off. There's big divergence. Look at this. Look at this. Last 2 weeks, we've been going down on techs in South Korea, but the NASDAQ 100 in the US, the last few weeks, just going straight high. That's major, major divergence. Also, I want to show you something else that's not making me feel warm and fuzzy. It's the VIX index. If you look at the VIX index, this is the index that measures volatility in the S&P 500 using the at-the-money options. And typically, VIX has been trading below 20 before February. It's been very complacent. Let me show you here. Let's go to daily. Let's go to 1 year. And let's change it to a line chart. And as you could see here, it was trading at 12, 14, which means the volatility, the trading range, and the fear level in the market was much, much lower. Then it spiked really, really hard and went all the way to 80 during the February crash, and then it's been coming down. But look where it's been. It's at 22. Now, typically, now it's moving down, but typically, if you were to look at VIX and it was at 22 back in January, you would think the market is very fearful because that's twice as much volatility as we saw pre-February. So imagine the market is all of a sudden twice as volatile because the VIX measures the volatility, the trading range. And 22 is about twice 11, 12, right? It's roughly 2 times, give or take. I'm not gonna, I'm just averaging it out. So the bottom line is volatility is still 6 months after the crash, twice as high as it was prior to the crash. Now, you could argue and just say, well, Roger, volatility doesn't mean it's gonna go bearish, it can go bullish. That's true. It's just telling us that volatility is twice as wide as usual. In other words, a stock that was fluctuating $1 is now fluctuating $2. A stock that was fluctuating $10 is now fluctuating $20. But here's the thing. There's really no reason for the market to be twice as volatile right now. And usually, VIX levels go up not when volatility is anticipated to be higher, but when fear levels are anticipated to be higher. So I am seeing fear levels still a lot more or a lot higher, a lot stronger than they were prior to the crash. And they're not cooling off. And 6 months is quite a long time, but we're still seeing volatility levels about twice as high. Now, and as equally as important is option premium. I was looking at option premiums on the S&P 500. I was looking at open interest. And I was looking at puts compared to calls. And I was looking at September and January expirations just to kind of get an idea of where we stand and where we could be moving. And I'm going to tell you, for the September 18th expiration, and that's, let's see, we're right now August 24th. September 18th expiration is about 3 weeks from now. So if you look, and my internet's a little slow here. Let me just quickly pull this up. Let's see here. If you look at September the 18th, which is a monthly expiration, and if you look at the pulls, if you look at the calls compared to the puts, there's a big, big difference. For example, the September 18th, 270 puts, they increased open interest in the last few weeks by 40,000. So you're probably thinking, well, what did the calls increase by? Hardly even 10%. 40,000 increase versus like 1,000 increase. So there's a lot more open interest in the puts than in the calls. Well, one strike price could be a coincidence. So I decided to look at the 240 put, the deep in the money put, right? I wanted to see where the in the money puts are increasing. It's higher. The open interest on the 240 put is higher by 62,000 contracts, okay? So the in-the-money options for the S&P 500 for the September 18th expiration are increasing substantially. I mean substantially. And in case you're looking at the calls, the call increased by about 2,000 contracts. So 62,000 increase on the puts, 1,000, 2,000 on the calls. Similarly with the 270 strike price, we increased 40,000 on the puts, hardly any on the calls. But the bottom line is you're getting all of my numbers. And again, September 18th, 270 put, 40,000 increase in open interest. Now let's look at January. September, the puts are really, really strong compared to the calls. January 15th expiration, we looked at the 285 put. It's higher by 25,000 contracts over the past few weeks. So again, the September contract, a lot more put buying than call buying. January 15th expiration, 25,000 more contracts than 2 weeks ago. So let's review. We're seeing divergence between the S&P 500 and momentum levels. S&P 500 is going higher, momentum levels are going lower. We're seeing divergence between the open interest, we're seeing divergence in the NASDAQ between the KOSDAQ, which is a South Korea tech sector, and the NASDAQ 100. Big divergence. We're also seeing divergence between momentum levels, like we're seeing in the S&P 500, but we're seeing it in the NASDAQ, and we're seeing the same thing with momentum levels versus price action. Price is moving higher, but open interest and momentum levels are narrowing. So there's a lot of things happening internally in the market right now that you need to be aware of. And finally, we're seeing put open interest on the September 18th contract and on the January 15th contract. You got one put where 40,000 more puts are being bought, 1,000 calls are being bought. Another contract, 62,000 puts are being bought, 2,000 calls are being bought. And another contract, 25,000 puts are being bought, 3,000 calls are being bought. So the difference is striking, and that's happening right now. And those signs are all pointing to a cool-off in the broad market, and especially in the tech and the biotech sector, because those two industries or sectors have been really heating up a lot, and they need a little cool off. That rubber band is stretched out to the tilt. Now I went through some of these analyses in the morning, and I go through them sometimes, but the puts, the divergence between the KOSDAQ, the South Korean index, I mean, look at this, last 2 weeks, we're going straight down. The QQQ, look at this thing. Let's look at it over a period of a month. Higher, right? But the other index that we were looking at, lower. Let me just pull it up again. And again, this is a very tech-heavy index. And I know one trades here, one trades in South Korea. But again, they usually follow each other with about 85, 90%. And they're not doing that right now at all. Look at the trend. Look how strong it's been. It's been just like the NASDAQ. But look at the last month. That's a big giveaway. And I hope that helps. Talk to you guys soon. Take care.